Ethereum will hit $60,000 within the next 5 years. That's not clickbait. That's the latest price target from Tom Lee, one of the most consistently accurate market commentators of the last decade. Not someday, not in some distant future. His base case is Ethereum at $60,000 within the next 5 years.
I think Ethereum between now and year end, so let's say Bitcoin is 2x upside from here. I think Ethereum is more than 2x upside from here. But longer term, in the BitMine presentation, we pulled some work from Mosaics, and let's say it's 5-year view for Ethereum. It comes to around $60,000 per ETH. So a lot of upside in the next 5 years.
And the craziest part? His call isn't built on hype. It's built on 3 unstoppable forces colliding right now: Wall Street adoption, stablecoins going mainstream, and AI is demanding a trust layer. All of them converging on the one blockchain that's boring, reliable, and built for institutions: Ethereum. In this video, I'm going to break down exactly why Tom Lee is so confident in that $60,000 number and why this cycle could finally prove Ethereum's biggest believers right. But first, most of you watching right now aren't subscribed. If you find value in these deep dives, hit that subscribe button. It's free, it helps the channel grow, and you can always change your mind later. So why should you care what Tom Lee has to say? Because this isn't some influencer throwing out wild numbers. Tom has been making bold calls on crypto since 2017, back when bringing up Bitcoin or Ethereum in a Wall Street boardroom could get you laughed out of the room. He was one of the first mainstream strategists to argue that Bitcoin could become digital gold and that Ethereum was worth allocating to alongside it. At the time, those ideas were dismissed as fringe, even career-ending. And yet, history proved him right. His early fair value models for Bitcoin, ridiculed when they came out, ended up landing right in the range the market eventually reached. That's the track record. When Tom Lee sticks his neck out, it isn't about hype. It's because he sees structural shifts that most people are too early or too scared to call. And now, he's pointing that same conviction at Ethereum. If you think Ethereum has been underperforming for years, you're right. And that's exactly why this setup is so powerful. While traders chase the shiny objects, fast chains, cheap meme coins, quick gains, Ethereum spent the last cycle doing the boring but necessary work of re-architecting itself. It moved to proof of stake. It tightened its issuance and inflation model. It shipped upgrades that cleaned up the network's economics and made Ethereum itself a scarcer, yield-bearing asset. That kind of work doesn't light up price charts in the short term, but it lays the foundation for explosive upside later, lower net supply, native staking yield, and a track record of uptime and security that institutions demand. Here's the mental shift most people miss. Retail investors chase speed and memes. Wall Street cares about reliability, settlement finality, governance, clarity, and yield. Speed can be added on layer 2s, but you can't bolt on a decade of network effects and near zero downtime. That's Ethereum's edge. The boring chain is about to become the most important one. Tom's first pillar is stablecoins, and this is where most people seriously underestimate the size of the prize. The US dollar already dominates global trade and central bank reserves, but inside crypto, its grip is even tighter. Almost every transaction is quoted in dollars. Now policymakers are stepping in. They don't just want stablecoins, they want compliant, scalable stablecoins that can plug into the financial system. Put that together and the picture is obvious. A multi-trillion-dollar stablecoin market is coming, and it will need the most reliable, institution-ready settlement layer. But that doesn't mean only Ethereum wins, but it does mean Ethereum is the chain best positioned to capture the highest quality flows from banks, broker-dealers, payment networks, and tokenized treasuries. Institutions don't care about raw TPS. They care about standards, uptime, and security.
In the stablecoin world, the US dollar pair actually in crypto transactions is like 99% dominance. Almost everything in crypto is quoted in dollars. So really, when we think about the future stablecoin, it's really the dollar becoming the stablecoin of choice. And, that's because everyone likes getting stuff quoted in dollars and people like to use dollars. I mean, whether it's a merchant in India or Turkey or someone in Dubai buying real estate with, actually Tether. So if the dollar is the quoted pair in the future of stablecoins, then the market share that we've seen up until this date might shift. Because as you know, 80% of stablecoin transactions do take place outside the US. And it's been mostly Tether. And Tether on Tron or Tether on other coins, on other blockchains. But
chains.
But I think that the U.S. government wants to have a say in this stablecoin future. And so I think it's going to be more about compliant blockchains where the dollar stablecoin is going to be allowed to operate. And that's my guess. So, and if Treasury Secretary Besson is right, and it's a $4 trillion market, which is $4 trillion owner of treasuries, like literally the U.S. will never have to worry about funding its debt. Because the Tether operates with the least friction. So like USDT on Tron will still operate freely. And, we can always cross-chain it and do a swap back into another compliant stablecoin. So, yeah, you're right. I would probably preface it by saying I don't think ETH is the only chain that's going to work on stablecoins, but I think it's still the biggest chain. And then, of course, as you know, the power law would kick in, so that ETH's premium should have the biggest recognition of price premium. Not for the stablecoin, but actually for the ETH token.
And here's why that matters directly for Ethereum. If the dollar rails run on Ethereum and its L2s, then base layer demand rises. Fees rise, burn rises. Staking yield becomes a baseline. In other words, stablecoins don't just use Ethereum, they feed its token economics, turning Ethereum into a cash flow-like asset that benefits every time stablecoin activity scales. The second pillar in Tom Lee's thesis is AI. As AI models become more agentic, acting in the real world, making decisions, executing transactions, questions of identity, provenance, and instruction verification stop being optional. They become critical. Think about it. Last year, over 50% of internet traffic was bots, and that was before this new wave of autonomous AI tools. The next generation will be smarter, faster, and infinitely harder to detect. AI's core problem is trust. Who issued the command? Who owns the data? Who can verify the outcome? That's where blockchains come in. Public ledgers and zero-knowledge proofs create verifiable trust at internet scale. They provide a neutral settlement layer AI systems can anchor to.
AI is going to become a lot more sophisticated. Because remember, if you're training AI on vision, like actually not just internet and Tinder and Facebook messages, but actually like it's in the real world, you're increasing a vastly amount of information, but then it's also making it harder to verify and secure, who's really issuing instructions. And that's where blockchains and zero knowledge proof become important. Well, that's a third sort of story arc. All of this should benefit the most reliable smart contract platform, which is Ethereum. And it has zero downtime. Of course, it needs a lot of work to scale. It's scaling, but, to be super scaling.
Tom's view is that AI and finance converge on-chain, and when they do, the platform with the most reliable smart contract base, the largest developer ecosystem, and a proven track record of uptime captures the lion's share. That platform is Ethereum. The result? Structural, non-speculative demand for block space and for the staking-backed security that underpins Ethereum itself. The third pillar in Tom Lee's thesis is something Wall Street already knows, inside and out. Treasuries. In crypto, they're called Digital Asset Treasuries, public companies that raise equity, then use their balance sheet to accumulate crypto. You've already seen the Bitcoin version with MicroStrategy, but Tom argues that Ethereum's model is even cleaner. Why? Native yield. Ethereum pays staking rewards. Treasuries can stake 100% of their holdings, while ETFs can't. Power law and governance. Large treasuries don't just hold Ethereum. They become part of the network's infrastructure. They can seed DeFi liquidity, partner with Wall Street, and help shape upgrades. Velocity. Successful treasuries grow their Ethereum per share faster than Ethereum's price alone. That creates a reflexive premium. Raise more, buy more, grow faster.
On July 8th, when the first transaction closed, the $250 million pipe, there was $4 of Ethereum held per share. And then on July 27th, we did an update, and we'll be updating it again soon, but a month ago on July 27th, the updated holdings of Ethereum per share was $24, $22.84. Okay, so Ethereum...
It's probably double that now, Mario, or 3 times.
That's insane. So what happened is Ethereum didn't have to go up in price, but your share price intrinsic value went to 23. That was a month ago. So you can see that if there is some sort of crypto winner in the future, like
there's a lot of room.
Yeah, like it depends on how much ETH you're stacking per share. You know what I mean? Because like,
Yeah.
see, from the July 27th date, Ethereum was basically flat, and you went from $4 to $23 of ETH per share. So even if ETH fell a lot, you were still better off than you were on July 8th.
Tom points to BitMine as the case study. In July, it moved from roughly $4 of Ethereum per share to $24 in just weeks, without Ethereum's price needing to moon in that window. That's the velocity story institutions understand. Accretive per share growth plus yield. And as more treasuries spin up, it creates a new class of long horizon, net buyers that smooth out volatility and reinforce the base. In other words, DATS don't just buy Ethereum, they build a flywheel around it. Of course, global liquidity still matters. It always has. Crypto has always been tied to the broader money cycle. But Tom's bigger point is this: the buyer mix has changed. This isn't just retail traders chasing halving cycles anymore. The new marginal buyers are institutions, and even sovereigns, building strategic positions that they don't plan to sell next quarter. That shift changes everything. When the buyer has a mandate, a balance sheet, and a multi-year horizon, the market behaves differently. Dips get bought, winters get shallower, adoption narratives keep compounding instead of stalling out.
I would say that it's not just institutions that are coming and buying Bitcoin now. I think that there is sovereign purchases of Bitcoin taking place. And, the U.S. government, while hasn't completely articulated its strategy for building a Bitcoin strategic reserve, but we know the U.S., when oil prices are low, they are a stabilizer for oil because they are filling that SPR, or Strategic Petroleum Reserve, at low prices, and that always puts a floor for oil. If Bitcoin enters a winter and the U.S. pursues a budget-neutral strategy to acquire Bitcoin, that means there'll be really active buyers of Bitcoin at lower prices. So if you always have a buyer at lower prices, you're kind of bounding your downside.
Tom's view is simple. As long as these new players keep stepping in, the old boom and bust pattern looks less like a rule and more like a fading memory. So how does Ethereum actually get from today's price to Tom Lee's $60,000 target? It comes down to 5 straight steps. Number 1, stablecoins scale. Dollar stablecoins grow into the multi-trillion bracket on compliant rails, and Ethereum captures a big share of that settlement and security demand. Number 2, AI-driven trust. As agentic AI and real-world robotics expand, identity, provenance, and payments get pushed on-chain. Zero-knowledge infrastructure matures to meet it. Number 3, treasury flywheel. Digital Asset Treasuries keep compounding Ethereum per share, creating persistent buy pressure that traditional ETFs can't match. Number 4, uptime plus L2 scaling. Ethereum maintains reliability while layer 2 throughput explodes and the developer ecosystem keeps shipping. Number 5, policy clarity. US regulators continue moving towards stablecoin standards, unlocking deeper institutional flows. Do all 5, and you create multi-year, non-speculative demand for block space and Ethereum security. That's the foundation for a $60,000 Ethereum.
Didn't you say you wouldn't be surprised there's a 50-50 chance that Ethereum could flip Bitcoin as network value?
That's right. So I think that there's maybe at least a 50% chance Ethereum's network value flips Bitcoin.
And Tom Lee's words make it clear. This isn't just a dream scenario, it's his base case. Could faster L1s win market share? Absolutely. Some will thrive. But Tom's point is simple. Institutions don't care about meme coin throughput. They optimize for governance, security, uptime, and standards. The boring stuff that actually matters when billions are on the line. Could a global liquidity shock slow everything down? Of course, every risk asset is exposed to that. But here's where this cycle looks different. The new buyer base, digital asset treasuries, large institutions, even sovereign entities. These players don't panic sell into a 30% dip. They allocate with mandates and multi-year horizons. That kind of buyer bounds the downside in a way crypto has never had before. Tom Lee's $60,000 Ethereum call isn't some wild moonshot. It's a framework built on fundamentals. Stablecoins are set to crown the dollar on compliant rails, and Ethereum is the settlement layer best positioned to capture that demand. AI is advancing so quickly that it needs a verifiable trust layer, and Ethereum's infrastructure and zero-knowledge technology are primed to deliver it. Digital Asset Treasuries are compounding Ethereum per share at a rate Wall Street already understands, creating a structural bid that doesn't go away when retail sentiment cools. Policy is opening the door to institutions, and Ethereum's own economics, staking yield, burn, and uptime, do the rest. Put it all together, and the picture is clear. $60,000 within 5 years isn't hype, it's plausible. And when you zoom out, the idea of Ethereum flipping Bitcoin stops looking like a meme and starts looking like math. And hey, if you've made it this far into the video, you're clearly not just skimming crypto headlines. You want to understand what's really going on. That's exactly why we write Crypto Nutshell. It's our free daily email read by tens of thousands of investors around the world. 5 minutes every morning gives you the biggest stories, the sharpest predictions, and the on-chain data that actually matters. It's fast, it's free, and it keeps you one step ahead. Hit the first link in the description and subscribe today. Thanks for watching. I'll see you in the next one.